June 21st shed equity funds for a second successive week in the 7 days to June 19, exercising caution as they evaluated the Federal Reserve's hawkish signals and ongoing political risks in Europe. They offloaded U.S. equity funds of a net $8.37 billion following $21.54 billion worth of weekly net selling in the previous week. Data from LSEG showed. Last week, the U.S. Federal Reserve kept interest rates steady but scaled back its projected rate cuts for the year from 3 to 1, adopting a more hawkish stance than anticipated. The S&P 500 and the Nasdaq hit record highs on Thursday, boosted by strong gains in Nvidia and indications of a gradual easing in the labor market and inflation levels. By segment, U.S. large-cap and multi-cap funds led outflows as they saw $4.88 billion and $1.45 billion worth of net sales. Mid-cap and small-cap funds also suffered $680 million and $574 million worth of net selling. Among sectoral funds, healthcare and industrials both had about $150 million worth of net selling each. The tech sector still attracted a net $554 million, the second weekly inflow in a row. Meanwhile, U.S. bond funds observed a net $991 million worth of purchases during the week, the smallest in 3 weeks. U.S. short, intermediate government and Treasury, and U.S. mortgage funds experienced $741 million and $435 million worth of net purchases, respectively. Short, intermediate investment grade funds, however, suffered $582 million worth of net selling, the first weekly outflow in 5. Money market funds, meanwhile, saw about $21 billion worth of net disposals after 2 weekly inflows in a row. New York, June 21. Reuters. A gauge of global stocks declined for a second straight session on Friday, weighed down by weakness in technology shares. While the dollar hit its highest level since early May as a gauge of U.S. business activity edged up to a more than 2-year high, S&P Global said its flash U.S. Composite PMI Output Index, which tracks the manufacturing and services sectors, inched up to 54.6 this month, the highest since April 2022, from a 54.5 reading in May. A reading above 50 indicates expansion. However, while a rebound in employment helped lift the reading, price pressures eased, adding to recent data that has boosted optimism that inflation may be cooling. On Wall Street, the S&P 500 and Nasdaq finished slightly lower as Nvidia shares fell more than 3% as the biggest drag on both indexes and sending the tech sector lower. Despite the decline, the chipmaker remains up about 155% on the year as an intense rally in AI-related stocks has lifted both indexes to multiple record highs in recent days. We've had a very strong run, especially in the S&P over the last couple weeks. So not surprised to see things kind of take a pause and settle down, said Zachary Hill, head of portfolio management at Horizon Investments in Charlotte, North Carolina. The Dow Industrials managed to eke out a small gain, in part driven by a climb in McDonald's shares. The Dow ended the week up 1.44%, its biggest weekly percentage gain since mid-May. The S&P rose 0.61% for its third straight weekly advance. The Nasdaq rose only 0.003% on the week, its third straight weekly advance. The Dow Jones Industrial Average rose 15.57 points, or 0.04%, to 39,150.33. The S&P 500 lost 8.55 points, or 0.16%, to 5,464.62, and the Nasdaq Composite lost 32.23 points, or 0.18%, to 17,689.36. MSCI's gauge of stocks across the globe fell 2.98 points, or 0.37%, to 801.37 after touching an intraday record of 807.17 on Thursday, but was still on track for a third straight week of gains. Other economic data on the housing market showed U.S. existing for a third straight month in May, as record high prices and a resurgence in mortgage rates kept potential buyers on the sidelines. European stocks closed pressured by falls in bank stocks and technology shares against a backdrop of economic data showing Eurozone business growth this month. The Stoxx 600 index fell 0.73%, while Europe's broad FTSE Eurofirst 300 fell 15.59 points, or 0.76%. U.S. Treasury yields briefly inched higher after the data but were largely little changed on the session, with the yield on benchmark U.S. 10-year notes 0.1 basis point higher at 4.255%. The 10-year yield was set for its first weekly climb after two straight declines. The dollar index, which measures the greenback against a basket of major currencies, gained 0.17% to 105.81. With the euro down 0.09% at $1.069. Sterling slightly weakened 0.05% to $1.2649. Against the Japanese yen, the dollar strengthened 0.43% to 159.59. That level had not been seen since late April when Japanese authorities intervened to halt the rapid fall in the currency. Japanese data earlier on Friday indicated the country's demand-led inflation slowed in May, clouding the picture for a rate hike from the Bank of Japan. Bank of Japan Deputy Governor Shinichi Uchida said on Friday the central bank was willing to raise rates if the economy and prices move in line with its forecasts. But signs of weakness remain. In commodities, the stronger dollar helped send oil prices lower, with U.S. crude settling down 0.69% at $80.73 a barrel and Brent off 0.55% on the day to settle at $85.24 per barrel. Both crude benchmarks finished up about 3% on the week. However, June 21, Reuters, Canada's resource-heavy main stock index ended lower on Friday, extending its weekly loss, as declines for commodity prices weighed on energy and metal mining shares. The S&P/TSX Composite Index ended down 26.49 points, or 0.1%, at 21,554.86. For the week, the index was down 0.4%. It was the fifth straight weekly decline for the index, which is the longest such stretch since May 2023. This is the momentum of everything going to the U.S., said Paul Gardner, a portfolio manager at Avenue Investment Management. With the relative weakness of oil in the commodity space, the TSX has given back some gains. The Toronto market has advanced 2.9% this year, much less than the 14.6% gain for U.S. benchmark the S&P 500, which has greater exposure to high-flying technology shares. The materials group, which includes metal miners and fertilizer companies, fell 1.3% as gold and copper prices declined. Concern over surplus supplies and sluggish demand in leading metals consumer China weighed on copper prices, which have pulled back from a record peak last month. Energy also lost ground, falling 1.4%, as the price of oil settled 0.7% lower at $80.73 a barrel. Combined, the energy and materials sectors account for 32% of the TSX's weighting. The world doesn't want to know about Canada. We think it's pretty reasonable to be exposed to Canadian assets because they trade far cheaper. Gardner said. The TSX's 12-month forward price-earnings ratio, a key measure of valuation, has fallen to 13.9 this month from 14.7 in March. LSEG DataStream data shows. Among the sectors that gained ground was technology. It rose 1.1% and consumer staples added 0.5%. New York, June 21. Reuters. A blistering rally in U.S. big tech stocks may be due for a breather, offering hope for market segments that have been more tepid this year. Although the S&P 500 is up 14.6% this year, most of the broader index's gains have been concentrated in the information technology and communications sectors, up 28.2% and 24.3%, respectively. The rest of the market has been more subdued. The next best performing sector, utilities, is only up 9.5% year to date. Many investors believe the long-term case for tech stocks is solid, given their strong earnings and excitement over the revolutionary potential of artificial intelligence. But huge price gains, including Nvidia Corp's 155% year-to-date run, have stirred worries that the tech rally might be overheated. Market laggards such as small caps and so-called value stocks such financials and industrials may be looking like bargains. Nvidia has been a rocket ship, and when things go up this quickly you don't want to be the last one through the exit door, said Michael Purves, CEO of Ʀᴏ Capital Advisors. People want to be invested in this equity rally, and if they sell Nvidia, the most likely places they are going to go is value and cyclical stocks. A rotation out of big tech could allay that have arisen in recent weeks, as the market rally has once again narrowed to a handful of names. About 60% of the S&P 500's total return of more than 14% for the year has been driven by 5 companies whose shares have some of the heaviest weightings in the index: Nvidia, Microsoft, Meta Platforms, Alphabet, and Amazon.com. Data from S&P Dow Jones indices showed some signs of big tech exhaustion emerged in the past week. Nvidia shares are down 10% from their peak reached on Thursday, taking the chipmaker out of its short-lived position as the world's most valuable company. Nvidia is on track for a 4% decline for the week, while the S&P 500 is on track for less than 1% gain. Closely watched economic data in the week ahead, including inflation data on Friday, could also affect investor positioning, as market participants gauge whether a nascent slowdown in inflation is continuing. Tech appears overextended based on several barometers, Purves noted. The relative strength indicator of the Mag 6 index, which measures the speed and magnitude of price changes in the stock market's 6 biggest stocks, is at the highest it has ever been, he said. Meanwhile, the price ratio between the Nasdaq 100 and the S&P 500 equal weight index, a proxy for the average stock, has jumped 9% since the beginning of June. He said, the S&P 500, by contrast, is up nearly 4% this month. Optimism is high among retail and institutional investors, which some view as a contrarian indicator because it means the bar for positive surprises is elevated. The AAII sentiment survey was steady at 44% in the week ended June 19, about 8 percentage points above its historical average. Sentiment among fund managers in the latest survey by BofA Global Research was at its highest level since late 2021. With investors trimming cash positions and increasing equity allocations, the 13% month-to-date gain in the VanEck Semiconductor ETF is a sign that AI fever might have gone too far, said Larry Tentarelli, chief technical strategist at Blue Chip Daily Trend Report. In the near term you could get a pullback in tech and semis. and a healthy rotation into other parts of the market that would keep this bull market going. Even if a pullback does occur, there are few signs investors would leave tech and growth stocks for long. Betting against tech has been a losing proposition over the last decade. As the Nasdaq 100 index has advanced more than 400% while the Russell 1000 value is up about 70%. Over the same time, the Russell Value Index is up 5.6% this year. Investors have given an even chillier reception to small cap stocks, with the Russell 1000 down 0.5% year to date. Tech could rebound fairly quickly as investors rush to buy the dip. The Nasdaq 100 took 5 weeks to reach a new high after falling as much as 9% in April. I don't get the sense that investors are looking to ring the register on this and book gains, said Jason Alonzo, portfolio manager at Harbor Capital Advisors. If anything, I'm seeing people who feel that they missed it trying to get in on this trend. June 21. Reuters. The S&P 500 and Nasdaq closed marginally lower on Friday, weighed down by a decline in Nvidia shares for a second straight day, which dragged down the technology sector. Technology was the biggest loser among the 11 major S&P 500 sectors, down 0.84%, weighed by Nvidia, while communication services led the gain. It's Nvidia's game, and the rest of us are just pretending to be here, said Michael Green, chief strategist at Simplify Asset Management in Philadelphia. Basically all the activity is now concentrated in Nvidia call options, he added. 7 million option contracts Nvidia have traded. That's something in the neighborhood of 3 or 4 times the quantity of contract volume that would have traded for the market in total 5 years ago. The Dow Jones Industrial Average rose 15.57 points, or 0.04%, to 39,150.33. The S&P 500 lost 8.55 points, or 0.16%, to 5,464.62, and the Nasdaq Composite lost 32.23 points, or 0.18%, to 17,689.36. Shares of megacaps Microsoft, Alphabet, rose between 0.92% to 1.89%. Apple slipped 1.04%. We've had a very strong run, especially in the S&P over the last couple weeks. So not surprised to see things kind of take a pause and settle down, Zachary Hill, head of portfolio management at Horizon Investments in Charlotte, North Carolina. Friday's trading could be more volatile than usual due to triple witching, the simultaneous expiration of stock options, stock index options, and stock index futures. U.S. reached a 26-month high in June amid a rebound in employment, while easing price pressures suggested the recent inflation slowdown may continue. Flash services PMI increased to 55.1 this month, above expectations of 53.7, while manufacturing PMI edged up to 51.7, compared with expectations of a dip to 51. May home sales fell to a seasonally adjusted annual rate of 4.11 million units versus expectations of 4.10 million units. Money markets are still pricing in a 58% chance of a 25 basis point rate cut in September, and still expect about 2 rate cuts this year. According to LSEG's Fed Watch data, AI chip firm Nvidia dropped 3.22%, while semiconductor stocks Qualcomm, Broadcom and Micron Technology were down between 1.36% and 4.38%. Wall Street's bumper gains since the final leg of 2023 have been primarily driven by the likes of Nvidia and a handful of other heavily weighted stocks linked to artificial intelligence. Analysts, however, have raised concerns whether the strong increase in their valuations is sustainable. Shares of Spirit AeroSystems rose 6.00% following a Reuters report that Boeing is nearing a the airplane parts supplier after months of talks. Sarepta Therapeutics soared 30.14% after the US FDA allowed of the company's gene therapy for patients with Duchenne muscular dystrophy aged 4 and older. Declining issues outnumbered advancers by a 1.03 to 1 ratio on the NYSE. There were 98 new highs and 73 new lows on the NYSE. The S&P 500 posted 23 new 52-week highs and 2 new lows, while the Nasdaq Composite recorded 34 new highs and 186 new lows. Volume on U.S. exchanges was 17.68 billion shares, compared with the 12.05 billion average for the full session over the last 20 trading days.